What's up, everybody? Before we get started on the show, I just want to give a quick shout out to our new Forward Guidance newsletter. It runs 5 days a week and talks about all things macro, digital assets, and how the two worlds are starting to collide together. I'm a writer for it at least once a week, as well as a very talented editorial team. And so check the link in our description to go sign up today. It's free and you won't regret it. All right, back to the show. What's up, everybody? Just want to take a second out of the show to talk about the next major Blockworks conference that's happening. Permissionless 3 is a leading crypto conference, and it's going to be happening in Salt Lake City this year from October 9th to 11th. There's going to be some major legendary speakers there from the likes of Balaji, Chris Dixon, and macro veterans like Dan Tafiaro will also be there. Not only that, but we're also going to be doing a live recording of the weekly Roundup Guys Emporium edition. So you can come meet myself and Tyler and Quinn, and even Mike will be there. If you're interested, we have a discount code, FG10. Use that and you'll get 10% off as well. So I hope to see you there and that we can catch up. All right, back to the show. All right, welcome back to another Roundup edition of Forward Guidance. Got the trio here again, once again. How's your, just recording here at the end of the week, a little bit later than normal. So we're actually right on market close. What's going on, guys?
Not much. Fun week as always. Hopefully we don't have to be at the screens this weekend. Can enjoy the first fall.
We gonna get the weekend Bitcoin pump or what?
It's brewing. We'll see.
The nano zone is coming, boys. It's coming.
The banana. I think Raul's moving to a banana cake that he's stacking up. So there's a banana zone cake coming up.
Okay.
But it sure feels like it's building. Cool. Before we get into everything, I do gotta pump my bags a little bit. We are a week out from Permissionless, the conference, the big conference. If you don't have a ticket, you are blowing it. You should get a ticket. We're going to be doing a live Forward Guidance Roundup episode there. I'm going to be doing an ETF debate with Jim Bianco and James Seifert. It's going to be really awesome. We have a 30% off code. If you use, it's my last name, so JAUVIN 30. That'll get you 30% off. We're a few days out here, so get your ticket, and it's going to be a good time.
Shameless plug.
Gotta do it.
I think they should use my code.
For a guy with a CFO, that was a great sales pitch for a guy with a CFO.
I mean, I did used to work in advertising before. I do understand consumer behavior a little bit.
Hit me with that employment number.
Yeah, there we go. Okay, let's get into what everybody wants to talk about. The jobs report that came out this morning. Let me go through a few data points here. So we had a very, 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 very strong jobs report. One of the best that I've seen in a very long time. So off the top here, non-farm payrolls, 223,000. Consensus was 125. Unemployment rate came in at 4.1% versus the consensus 4.2. And if you actually look at the unrounded numbers, it was 4.051. So if that was 4.05, we would have had a 4% print on the unemployment rate. Like, that is just a huge downside move. And not only that, we actually saw some positive revisions to those payrolls. So this is just from the top right here, just from Danny Dayan, who's been on the show a few times. But what he mentions is, more importantly, there were substantial revisions to prior months. What we thought were weaker reports were not quite at all. July was revised from 89 to 144, which is not terrible, and a mildly slower month, while August was revised from 142 to 159. So this was just, a gangbusters, just really stellar jobs report. I'm just going to go through a few slides here, and then we'll unpack and get our takes on it. So this is from Parker Ross, and just shows the contribution of month over month changes to the unemployment rate. And you can see, last month was the main reason for the decrease was just temporary layoffs that reversed, versus this month is just a completely different story. We've seen a very, very structural decrease in the unemployment rate, whether it's new entrants, re-entrants to the labor force, permanent job losers, they all came down. It's just, very structural and solid. And not only that, but the quality of it was really good. So this is something that I've seen a lot of people talk about, where it's, it's low quality jobs that we're adding. But this month we actually saw full-time workers increase and part-time workers decrease. So it was actually the full-time jobs that really took the torch this month. And I got to go on a little rant about revisions and revisionistas. This is another chart from Parker Ross, just looking at basically private job growth, excluding the birth death adjustment, which is the birth death model. And that's the one that gives a lot of issues in terms of revisions. on a non-seasonally adjusted basis was one of the strongest prints since 2012. So, even if you just look at the non-seasonally adjusted numbers here, this was a huge, huge, huge move. And so, okay, fine. We know there's going to be revisions. Like that's not something we're going to be surprised about, but this is something I've been thinking a lot about today, which is that you just bake it into your assumptions from the get-go and then look at the trends. So this is a really great chart from Econ Burger, just baking in, the revisions have been pretty linear, like they're not all over the place, they're not exponential. So you can make a decent forecast by just ratcheting it down here. And that's what that dotted line shows. So, okay, yes, there's going to be revisions to this number, probably lower. But the fact remains that even with those revisions, we're seeing a significant uptick in the payrolls report. This compared to the FOMC projections that were only just from a few weeks ago are already starting to look stale. So we've seen a pretty significant down move in the unemployment rate versus the SEP. And not only that, but the SOM rule, which we are pretty early to talking about, if you use the unrounded numbers, like Parker Ross did here, we're below, we basically reverse the SOM rule trigger. If you use the rounded numbers, we're right on the screws at 0.5. But yeah, we've reversed the SOM rule trigger. And when you look at it versus previous recessions, like this is just literally nothing comparable. You don't see 2 months of decreases of the unemployment rate after the SOM rule has been triggered. Like you just compare to every recession. So, I would say this is definitely validating. Obviously, it's just 1 month of data, but it's definitely pointing in the direction of a lot of what we've been talking about. Even just last week when I ran through the jobless claims data, that was pretty clearly showing what was coming up here. So I'm not seeing a recession. You guys seeing a recession?
No, I think my favorite, my buddy sent me this meme today that was like, I believe the data is manipulated. And then it's like, it's that Anakin meme. And it's like, you're long, right? And it's like the eyes, he's like, you're long assets, right? And I mean, we've been hitting it pretty hard. I think quotes on the show in the last couple of weeks being like, why are we even talking about the big bad R word of recession? It's just nowhere to be found. And I think the biggest point I would make on the topic is, yes, this very rightfully should remove some accommodation from the Fed's path of projected policy. Like no brainer. I saw some takes flying around from your perma bears on Twitter that was like, this is super bearish because it reduces the interest rate accommodation. And I mean, there's just something for everybody, right? Because a month ago, 2 weeks ago, we're perma bears because recession and the world's ending. So in reality, though, what the point I tweeted this week was, don't underestimate the impact of the global easing cycle. So ECB is communicating 50 bips through year end. Okay, they've already done 50. China's communicating what they're communicating. Bank of Canada, Bank of England, BOJ is taking rate hikes off. The Fed's locked into their easing path. Like they're not even like, this is a hot print, but inflation in their minds is still going towards their target. So this doesn't deter anything. It takes 50 off November, but they're still firmly in an easing accommodative stance. And if anything, the more that rest of world banks now, which have the green light to ease further, they lock them into that. Because if the Fed doesn't ease alongside, they actually tighten. And we saw what happens when that occurs, the Bank of England gilt crisis in October 2022. So you just have an unbelievably positive macro environment heading into year end. There's no recession. The consumer's fine. Job growth is back. Rates are lower by 75 bips, even after the big rally today, than they were in April. And I think we've kind of knocked down every, bearish take. The remaining one is, wow, equities are still expensive, and that's going to happen. But in that case, the spice and the liquidity and the economic strength is still going to flow. And that's why I think you start looking at the more speculative assets. Look through the 2021 ARC type names. Those are the equity version of crypto. Carvana, Lemonade, Upstart, Affirm, ASTS, all these things the charts just look like they're ready to, go full send. And I think that's what's going to come to crypto too, because no one's going to bid equities to a 45 forward PE, but they're going to bid something because you need to protect your real returns and your purchasing power.
I totally agree with that. Even though I want to disagree with you just by nature. But what people don't really understand is we're essentially in some sort of Ponzi scheme. It's a global Ponzi scheme. And I don't know why people have such a hard time understanding that, but you have a giant debt bubble in developed markets in China, and everyone needs nominal GDP growth to keep going. That's just the name of the game. And the middle class is clearly getting hollowed out by a lot of this stuff. The sentiment on the ground there really isn't great in the lower income buckets. But the capital, where the S&P is and all, where the capital sector of the economy looks, everything it seems to be fine right now. So, keep harping on that. I got a couple good fixed income charts to go back to, which is, slide 33. And this is historical credit spreads from JP Morgan. Currently in the high yield market, we're at 345 basis points of credit spreads. The US recession average is 971. If you look at leveraged loans, that's the second column. Currently we're at 466 basis points of spread. The US recession average is 1,058 basis points. So all these recessionistas, they're not even looking at the bond market at all. And I will continuously show this until someone else looks at this, because I feel like I'm a crazy person looking at this. And then go to slide 34. This is the high yield bond the default rate. So this is the default rate of high yield bonds. And you'll see the spikes during 2008 and basically any recession like in COVID in 2020, you saw the default rate spike again. JP Morgan just said this morning, we lowered our 2024 high yield bond default forecast by 75 basis points to 1.25% and left our leveraged loan default rate unchanged. So basically, leveraged loans default rate is rising a little bit, but high yield's going down. You don't see that in recessions. It's just that, I don't get it. So I'll stop there, but we can go back to what I think's going on in the marketplace is capital is just getting a little bit more aggressive as those credit spreads come in, and it allows companies to refinance. It allows them to have a lot of leverage and change their balance sheets.
Yeah. I mean, I really want to double click on that idea of just this global coordinated easing cycle and just like the bigger game at play. Like for me, a really interesting proof point for that was this new prime minister that came in for Japan. So the election occurred and is basically down between like a dove and a hawk, and the hawk won. And at first the yen rallied pretty strongly out of fear for that. And then a few days later, that hawkish prime minister was an outright dove, basically just came out swinging. It was just like, we're not going to hike rates anytime soon. That's a very different tune from what they were saying historically and their track record, and especially before they actually came out at the prime minister. So there's bigger games at play, and it's just like it's every global central bank is on an easing or dovish bias now. Yes, Japan's not cutting rates by any means, but they've stopped hiking, and that's all you needed to get things going here.
This chart, man, is so good. My message, do not overthink it. Do not overthink it. 2009, 2020.
They do. Most people look at this and they're like, oh my God, look, it's 2008. Look what happens. They're going to lower rates because there's a credit crisis. And that's why I keep going back to the credit markets.
Yeah.
So the last point on the continuation, and I'll put it on record. I'm going to expand on it for some other reasons in my monthly letter coming out this weekend. But I actually now believe that over the summer, I remained in like the no recession kind of growth scare camp, and started seeing in the charts and the data this idea that Q4 2020 is the best analog. And that was obviously a very strong growth period coming with extremely accommodative monetary and big fiscal going on, right? So today fiscals, and I kind of thought, okay, that's going to happen maybe, but it's more muted. So it might be, not as powerful or not as long lasting all the way through 21 because, fiscal is a little lower and monetary is not quite as accommodative. Well, now I think what might happen is I believe firmly that the Fed is kind of locked into this easing path. Forward guidance is one, but the global central banks, like we talked about, they have to remain coordinated, and maybe it changes. Sorry,
I want to play contra to that a little bit. They do, unless there is a geopolitical event, which I will say, like, this thing in the Middle East could spiral out of control.
Yeah.
That's a risk factor.
Yes,
that is concerning me, and you'll get into the oil market here in a few. But we're not seeing any reaction specifically in the past 2 days in the U.S. credit markets, or even in Europe or Japan, oddly. So
yeah, I totally agree. So let's assume, Joe, though, for now that the war is not going to happen. I think actually what will play out is the U.S. economy is actually, I think, going to reinflect higher and run really hot, because I think 100 bips, I think even 50 to 75 bips of Fed cuts with everything globally that's going on in easing is enough to reignite things. But the path we're on, where it's looking more like 75 to 125, I think the economy is going to like take off again and run really hot, because the Fed's going to be locked into this regime. And I don't think people are really understanding how like dynamite of a reignition in the economy can occur in these conditions.
Quinn, I agree with the analog to 2020, except for the one thing is just the US dollar. And this is something I've talked about a few weeks ago when just talking about how, I didn't see the dollar going any lower, even if the Fed was cutting pretty significantly. And I think, looking back at that analog, that's when, the US dollar was heading quite significantly lower. Whereas I don't really see it going that much below 100. I don't know if you do, but to me, that would be one difference. But I don't think it's a bad thing. We can have US dollar strength for a variety of reasons. We can have it as like a flight to safety into US dollar safe haven, or it's because of US exceptionalism and everybody else is sort of, I'm here in Canada, we're in a very different economic story versus the US right now. I think it's more so that US exceptionalism, and it's going to be more similar to, maybe just the end of that 2020 move where, the US was just so strong. What do you think?
No, I agree. So there's two ways I see it playing out. The dollar actually bottomed, like late December 2020, and then ripped into like Q1, Q2 of 21. So I kind of think we're there. Like I see, the US economy is still much stronger than the rest of the world. I do think we will be less dovish because of that than the rest of the world. However, there's a situation on the horizon where, yes, the dollar strengthened recently, and I think a lot of it is war-related kind of that and yields in oil. But if the Fed remains on this accommodative path, despite oil and bond yields coming higher, I think you might see a correlation switch where then people start to say, okay, they're staying loose when oil and rates are saying you should go higher or you should go more restrictive. And that to me would put pressure on the dollar. So at this level, I don't have a huge view. All my view is that like dollar between 100 and 105 or 95 and 105 is like not a problem. Like if the dollar starts breaking out to like 110 again, then we care. But like you said, this resurgence in growth and like US exceptionalism it's same thing why the 10-year going from 3.7 to 4 is not a problem, because it's on growth, not on like second wave of inflation.
Yeah, we're in a good news is good news regime. And don't get that twisted. This is not 2022 right now.
I think what we're all saying is what global central banks are doing is they are diluting their currency base. They are all diluting their currency base at the same time, which increases the collateral value in the system, which allows you to borrow at advantageous rates, which pushes growth because that money has to go somewhere. And that's sort of the balance sheet recession that Richard Koo talks about. Now China's involved and things aren't shrinking. They're trying to make up that gap of fiscal spend at the same time everyone else is. So it's going to be pretty fiery, and there might be, yields could rise. You're going to have some worries about inflation here, but growth should be okay at the same time. It is my read. And that's why we're seeing crazy stuff like Carvana. I talk about this every week, keeps going. I watched, if you could check out Slide, this is just slide 36. This is Rocket Labs. It's a space company, and this thing has gone parabolic. And just as so we don't own this disclosure, but it's just more of fascinating. If you go to slide 37, Rocket Labs is not profitable, but they're losing less money than they did previously. And this is also a function. They're growing faster, but they're losing less money, if that makes sense. So the stock is reacting to the fact that like their balance sheet will consistently get better here, and you have advantageous financing rates as well. So they're growing at 13% in 2024 and then 38% in 2025. This is just analyst estimates. That's that top right quadrant on earnings. And that has this outrageous effect to the stock price because it's basically been left for dead for 2-3 years. And then here's another great example. Go to slide 39. Clover Health, which was one of these like dog shit SPACs. It's almost left for dead. I mean, this thing was almost bankrupt. It's up, from I think pennies on the dollar to $4.
You know what's funny, Tyler, is how many shitty altcoins look like the same chart right now too. It's all doing the same thing right now.
It's the same proxy of liquidity. And at the end of the day, like our system basically functions as a giant refinancing cycle now. And that's the whole Michael Howell thesis. I can't pound that home enough is what's going on here. And until you see that go in reverse somehow, and you see earnings misses, credit spreads widening, a lot of what we see, the drawdowns are just systematic investors. It's all a giant quant program. We saw that the pullback and the VIX spiked. We basically got an inversion 2 days ago in the VIX, which is when the front month is more expensive than the 3 month. And that's a great buy indicator. So you're going to have all these quant guys give you opportunities to get in the market when there's, but largely we're still in a giant liquidity cycle.
Yeah. Well said, Tyler. So I want to just finish up our discussion on the labor market here and like what's next. So, okay, we have a labor market and jobs report today that says that the recession view is quite a bit less likely than it was yesterday. So now the decision is, okay, are we headed towards a soft landing? Are we heading towards a reacceleration into a no landing scenario? Or, is this just a one-off print and October is going to be way worse and we're going to be continuing to a hard landing? I think the October print is going to be a lot noisier due to what's going on with Hurricane Helene and all of those dynamics. So there's going to be quite a bit of noise in that print. But obviously that'll be, important to see whether this trend of improvement continues. The soft landing narrative, I tweeted this out earlier today, is I think it's completely dependent on what happens actually in the rest of the world. So if China can get underneath their deleveraging right now and actually ease enough to see a rebound, and if the other countries, the ECB is talking about cutting more here in Canada, we're talking about moving up to a 50 bips cut. If the rest of the world can improve their economic story and get in line with the US, I think you can see a bid up in commodities that could make it so the risk of inflation to reaccelerate higher increases, and that decreases the probability of a soft landing. If China doesn't quite get underneath it, that allows the Fed to cut quite significantly without the commodities bid up significantly, risk. So for me, I'm just purely looking at oil. If oil is above $100, I'm worrying about no landing. As long as it's below $100, I'm largely looking for a soft landing.
I like that framework.
Yeah.
It's growth story until it's not, right? Until the inflation says otherwise, which it's lagging. We know inflation lags, period. And we know what the Fed looks at to judge inflation lags, period. And then we know that the Fed sees the inflation data that's lagged, and they lag their restrictions. So, I mean, you just remind yourself about inflation at a minimum of 3-4 months from now, and then get worried if you want to get worried.
Yeah. It's an end of 2025 thing. It's not for any time soon.
What's great? I just got to add this to roast Quinn's hat a little bit. Biden has actually done a great job with the stock market and unemployment and getting inflation down, but he can't take a victory lap on this, because then it means hey, he just made the rich richer, and everyone down in the lower income is getting annihilated. So like, it's the weirdest concoction of like, he's actually done a great job managing, the global stock market and employment and earnings.
I didn't know that was the president's job.
Well, but like, he can't take a victory lap on it, which is being objective here. It's kind of hilarious the spot they put themselves in on that.
It's just kicking the can. I mean, I'm not like, I view each election as separate things and don't really feel party affiliation. I just kind of take a stance as it goes. But I said this last week or some week. I said, when the second and third largest stock markets in the world move 10% dailies back-to-back months, that doesn't tell you that underneath the surface, everything's calm, cool, and collected. So and you have probably the most unstable geopolitical situation we have. So I don't think it's as sanguine as the surface is. But
oh no, I'm not saying that, like, there's a guy.
But he is. I mean, the economy's strong. The stock market's all-time highs. Like, I think like Yellen. I would say Yellen has done the best job.
But here's my point: is I think, and this is where my heart goes out to like people struggling, but like, he's really helped the capital class quite a bit because you have giant fiscal plan. You have, it's really incredible. They say they want to help certain people, but then end up hurting them. It's like such a classic politician. That's bipartisan.
Yeah,
exactly.
I agree. I mean, just look at what Yellen's done with the Treasury. Like, they've floated it. What's up, everybody? Just want to take a second out of the show to talk about the next major Blockworks conference that's happening. Permissionless 3 is a leading crypto conference, and it's going to be happening in Salt Lake City this year from October 9th to 11th. There's going to be some major legendary speakers there from the likes of Balaji, Chris Dixon, and macro veterans like Dan Taffiaro will also be there. Not only that, but we're also going to be doing a live recording of the weekly Roundup Guys Emporium edition. So you can come meet myself and Tyler and Quinn, and even Mike will be there. If you're interested, we have a discount code FG10. Use that and you'll get 10% off as well. So I hope to see you there and that we can catch up. All right, back to the show. Let's talk a little bit, to the best of our ability about what's been going on in the Middle East, with the caveat that, all three of us are geopolitical LARPs. I'd like to say I know a thing or two about macro, but geopolitical, I try to react. I don't try to predict. But, in the interest of it being a relevant topic to markets and a market driver, Quinn, you've been thinking a little bit about some of the game theory dynamics behind what's been going on. Do you want to unpack that a little?
The best hedge thus far, because we've seen the stock market hold up, right? Because one, people probably are expecting Israel, expecting it to cool. It hasn't affected the markets the last 2 or 3 times it's erupted. Why would it this time? It fooled me once, kind of thing. So stocks have been fine, but we've seen the reaction in oil and the long bond, where the long bond hasn't been a flight to safety. Obviously, there's been some good growth data this week that's pushed yields higher. But I think the dollar and yields going up has also been an oil price thing and a geopolitical uncertainty thing. My opinion is it's unlikely this will escalate into full-blown war pre-election. I think post-election, it's a little dicier. So that's a risk out there. But Iran really does not want Trump. But if they escalate, it's likely to tip things in favor of Trump, just based on where the U.S. voter preference lies and how they prioritize, national security and strength. And Israel really wants Trump. We know that from the last 8 years of how they've fared kind of in both. So the risk is that Israel really pokes the bear here. I think we'll see this weekend. My guess is the White House is begging them and trying to do everything to just, kind of cool tensions this close to the election, because it would be pretty detrimental. But as far as markets, I mean, I put a tweet out this morning. It's kind of this precarious position because I've seen a lot of bearish views about how the market's complacent. And I don't disagree. I mean, we've had, like I said, all the times this has erupted, it's blown over and markets have rallied back to highs. So there's almost rightfully to be some complacency. But as a professional money manager, you also can't just sit on the sidelines, because the second this blows over, you're going to wake up to a 2% gap open and you're going to be underperforming. So what do? I think you have to be long oil, long, short the bond. But the other tough thing with that is if this does blow over, those hedges roll off, the volatility falls, and you're less suited. So it's an interesting dynamic. I would say the other thing I've noticed coinciding with my Q4 2020 analogy, I expect oil to outperform gold or from when the Fed started cutting, which has. And so I would say that's a pretty interesting data point here where gold is not breaking out to all-time highs despite some of the most tense geopolitical strife in many months, is probably a sign that positioning is very extended.
It was up every day for like 30 days.
No, maybe. I know that's. I mean, look, it's one of the strongest bull markets in the in assets right now. But I think positioning is quite extended. I think that in an inflecting economy, in a stronger dollar, higher yields, I think it's facing that headwind. From those aspects. So that's an interesting note because a lot of people I saw reaching for gold and gold calls, noting that vol is cheap, but I think positioning is a little rich there. So we'll see. This weekend should be good. Interesting.
Yeah, hopefully. I mean, I think it's a fair play to talk about positioning in gold. Is like Tara said, it's been just an absolute monster. But I think its resilience in the spite of everything is hinting a little bit about what's been going on with the Fed that we talked about. There's a debate about whether them cutting 50 bips into how the economy stands right now is a bit of a giving up moment on the 2% target, and that's going to lead to further global central bank tail risk, and people are going to want to bid up gold for that reason.
I don't know if you checked out silver lately, but it looks like a long-term cup and handle, and it just broke out. If this SLV breaks 30, man, it could be off to the races similarly. But what I think is really going on here is just the global treasury collateral, global reserve collateral is changing. And, we realize this is a giant global debt bubble. You need nominal GDP growth. So what is, you have to issue debt to actually stew that growth. And people are realizing, oh my God, yeah, the US could just issue debt forever. And I don't want to buy that debt necessarily if they're, just basically stewing growth with, debt. And so now it's going to gold. I think that's really what gold is reacting to, is treasury collateral, your reserve collateral is changing. And I think what I think is happening is it's happening at Bitcoin too, because people are going to say, hey, this thing is really interesting as a reserve asset. You can send $100 billion on the touch, and there's no real super fees, I guess. And that's huge for a reserve asset.
Yeah. I mean, the thing I would say on that is, the GLD divided by TLT chart is like the most bullish thing.
That's the generational trade right there. I think long gold, short bonds. Like, yeah,
you avoid everything. It's a risk off. Like, it's hilarious. And I think that's a key thing here is for the last couple of months, we were in a inversely correlated stock bond regime because the scare was growth. Yeah. And we're now backstopped growth with the Fed and global central bank puts. We are moving back to the 2022-2023 regime of positive correlation between bonds and stocks. And the thing I would say just about this huge, because I'm so bullish on the macro here, but you can't just say, well, I can look through, because if this does escalate, it's a big if then probability distribution. If it does escalate into a very intense conflict, that is very bad for for risk assets. And so you have to survive. Well, you shouldn't.
Initially, I agree with you initially.
Yes, the response is the response is oil spikes, they dump the SPR, they accommodate.
You get the quant var shock,
Yeah, but you can't just say, oh well, I know the end game is this, so I can just weather it, because you're gonna if they start blowing up oil and nuclear facilities, you're sitting through some gut wrenching days, and you kind of got to be prepared. So I just think, you might at times, if it gets really bad, you would have to extend your time horizon, but just being responsible with position sizing and how you're looking at that.
What's fascinating to me is market structure. With everything that's going on in the world, just 15 years ago, the market would not be at all-time highs, but because it's systematically in these quant CTAs are such a large percentage of the asset management industry now, they barely react to huge geopolitical risk. And that's just mind-boggling to me. I guess the fixed income market doesn't either, and that's actively managed. So I don't know. I don't know what to make of that. It's just kind of trippy.
It just shows though how much liquidity and how guaranteed in investors' perception, market participants' perception, the backstop is, right? It's just like, I don't care, which is it's when you think about it, it's sad because there's tens of thousands of people losing their lives daily for what just, there's other way, or 2024, there's other ways to solve disagreements than lobbing bombs. And, that's what the other thing is. We're talking about these things in markets perspective because that's our job. And, people pay me to manage money. They don't pay me to pontificate on moral issues, but it's fucked. I mean, this is like, it needs
I think
to
our whole generation feels that, like, all the incentives that globalization had meant well, but there were some massive side effects over 40 years that we all get now and we understand, but it's really hard to like untie those Band-Aids.
And then you have the fucking guys like Lindsey Graham, 2 seconds after this happens, comes out with a tweet, we need to bomb their nuclear facilities. It's like, dude.
Insane. Absolute war hawks.
Get out.
Get
out of here. These people, man, they just like, I can't imagine how much their pockets are being stuffed with, with the defense budget. It's disgusting.
Yeah. All right. I'm gonna pull a Monty Python, and now for something completely different. I want to spend a little bit talking about some in the weeds monetary plumbing stuff that happened this week and nerd out and geek out a little bit. I'm not a huge expert here, enough to probably just get myself into trouble. But this is quite relevant to understanding a bit more of the Fed's reaction function. So what this chart shows here is the spread between SOFR and IORB. So the secured overnight financing rate, which is basically just like a secured lending standard based on Fed funds. And the IORB is the interest on reserve balances. And so these are important rates, part of the Fed funds band complex. And so they're very important to understanding liquidity conditions in money markets. So this spread of SOFR to interest on reserve balances is a really quick and easy gauge to understand, is there strain in the money market system or not? And how are bank reserves doing? So what we saw is that we saw a major uptick in the SOFR to interest on reserve balance spread to, quite significant highs. And what happened is that the standing repo facility actually saw a $2.3 billion uptake. This, hasn't been tapped to this degree since June 2020, roughly. Back then, there was way higher dollar value, so I don't have them in this chart just so that you can see the change versus the last few years. But basically what happened here is that we've been going through a couple of years of quantitative tightening so far. And the Fed sort of has to feel their way down to what sort of level of bank reserves that they want to hit. And so what happened here is this, I wouldn't say this is like some big, amber alert, red alert type dynamic where we all need to freak out and say, oh, the system's breaking, we need to end quantitative tightening today. A lot of it had to do with quarter end dynamics, window dressing. There was a September fiscal surplus, which led to, more need for cash from primary dealers at this time. So these quarter ends are always going to be times where we see the strain occur if there's going to be some. So what we saw is this uptake, and this just shows basically the two yellow bars. That's the federal funds rate the federal funds rate band, the upper band and lower band. So the way that the Federal Reserve actually implements monetary policy and, having the Fed funds rate be where they want it to be is through having like a ceiling and a floor to the Fed funds band and letting SOFR and like the effective funds rate float, in between those bands on a daily basis based on, repo supply and demand. So what happened is that the SOFR rate actually exploded above the upper band. So above what is the upper band of the Fed funds upper band target, which is not a good thing. So what happened is that additional demand basically moved into the standing repo facility. And that's basically just like an instant uptake from the Fed directly overnight. So what does that all mean? So if you remember back in 2019, we had a similar issue happen, but this was during a time where there was no standing repo facility. So what happened is that repo rates exploded higher to like, I think it was like 9% or something like that. And the only way that dynamic stopped is because the Fed had to announce that they're coming into the repo market to lend overnight. So there was no standing repo facility available at any time for them to tap into. They had to actually come in. And this is where, I think I have a chart in here. Yeah, so you can see this arrow actually on this chart of the Fed's balance sheet. So even though we were seeing quantitative tightening last cycle, this Fed repo blow up happened, and overnight the Fed started to lend pretty freely in the repo market, and we saw the balance sheet start to expand again. So during this time, there was a lot of people saying, "Oh, this is QE again." They just don't want to admit it, and then the Fed is like, "No, this is not QE." So then people started calling it not QE. But what this all means is that it's it's not saying that the financial system's about to break. The standing repo facility largely worked how it was intended, maybe with a little bit of a lag because we did see the SOFR rate go above it. But what this all means is guarantee the Fed Bank of New York is looking at this, and they're starting to talk about, talking to the Fed governors, and then the Fed governors are going to start talking about when should we end quantitative tightening. Obviously we're not seeing this in like daily strain in money markets. It's just at the quarter end when it gets the most strained for demand. But I guarantee it's something that they're talking about, and there's a good chance that I wouldn't be surprised if come November they announce that quantitative tightening's done for this cycle, either in that meeting or by the end of the year.
That's wild. That's a pretty interesting, because you think about the most bearish thing is like if they were to just pause. Like I don't think it's bearish because I think the economy's fine, but like that's not as good for our liquidity driven assets. But I could see them doing the carrot stick where they're like, well, kind of like they did in June or May, was it? Where they're like, we're not hiking yet, but we're going to taper the unwind by extra too, right? And we pulled it forward a month, something like that. We're like, well, less rate cuts, but less QT.
Yeah. I mean, I just want to really emphasize that, like, this is not doom and gloom. The money market system is not imploding. It's still like $2.3 billion is pretty small in the grand scheme of things, but it is a signal. And I do think they're thinking about it.
I spent my first 15 years in finance trying to dig into all these things when it would happen. Like, what is an auction rate security in 2008? Why did it freeze? And then there's been like I countless. I can't even tell you. There's been 40 of these things, and every single time they just pull out a new acronym and just smack it down. So that's why I go back to the fact that they're world controllers, and if there's any volatility in like credit markets anywhere, they're going to make sure it gets stomped out, and everything is very. I guess the liquidity keeps pumping. And the only time there's a real big credit issue is when you lend to a part of the market that can't take the growth, can't satisfy it, which is essentially sovereign balance sheets.
Yes. I think that's such a good point, Tyler. And it just brings up, like, you can, when you go through your macro journey of learning things in the beginning, you want to understand every single plumbing acronym. And, I dig in a little bit to just nerd out, but I'm not making investment decisions because of what's happening in a monetary plumbing system. Tyler's, got more years of trading behind him than, myself and Quinn. And, he keeps it simple. It's just like, okay, credit spreads are ridiculously tight. You don't need to understand all these other things because it gets digested into credit spreads. Credit spreads are saying things are fine. That's a smart, efficient market.
I do want to show on that point, just to simplify it, like go to slide 42. This is one of those things where I think one of these bear porn Twitter accounts put this out. And I was like, this is the most bullish chart I've ever seen. Buying conditions for houses are like below 1980, and vehicle sales are, below 1980. And if this goes any lower, you'll have the social contract will break. If these things go lower, the entire world doesn't work. So that's where, I don't know, I just simplify it in my brain where if that's the case, like none of us are going to be eating. If your house just immediately, like all the equity built up for your entire career, there'll be people picketing, and then Congress will get together and they'll come up with another acronym and bail it out. So like when you see sentiment this stretch, is my point. It's pretty simple. Just like take the opposite side, especially when everyone else is calling for, the sky is falling, the sky is falling. Now that'll change here, as the market goes to new highs again. In the short term, I'm not necessarily like we're going to a buyback blackout for the next 2 weeks. Earnings are coming. Usually you get like a little volatility, but largely this is that chart shows the background is they need to politically make these things work. Otherwise society doesn't work.
Especially geopolitically. It's like, do you really want to trade nuclear potential? It's either just, fade it. And if it does happen, it doesn't matter because we're all dead anyway. So, just may as well fade it.
Yeah.
That chart is part of that. It's been a big difference of the sentiment stuff because that's the Michigan sentiment versus hard data. And it's have everyone, it's that market gives everyone something to latch onto. And I think part of it though is like, I look at that chart, it's like there's only way to go is up, and that's great if the economy. But the other part of that is that's the lower middle income, cohorts of the country saying we feel, forgotten and unfairly treated because we, it's sentiment. So it's not what I am outright, it's what I feel relative to everyone else. And they see the wealthy wages growing, their wages aren't growing because there's immigrants fighting for their jobs. They can't afford, they're levered on credit card bills and the interest rates tied to the front end are all-time highs. That's where this policy stuff gets in because Powell has to cut to save the lower middle income cohort.
Well, here's a little great increment is I have a couple buddies that they're 30, run a company. All of their money is tied up in the equity of that company. The company's growing great. They can't even afford a house. If they can't afford a house, nor a kid or family, but their company might be worth $100 million. How is that possible? And so, the sentiment for a guy who's a CEO of a company that's worth 50 million or whatever, where he can't get any liquidity, and he's probably saying, I can't buy a house. Houses are so overvalued. It's crazy. So you have to make the society work for those people that are about to have children. And in this next 10 years, there's going to be all sorts of stuff thrown at like younger millennials and Gen Z. There's going to be all housing things and it's going to be like $50,000 down payment. There's going to be all sorts of this stuff. It's going to be highly inflationary, and there's going to be lots of renegotiating of labor contracts. This union thing, the dock workers, that's just a start. I mean, this is a giant rotation back to labor.
Yeah, I saw a funny tweet on that long-short thing where it's like, yeah, they'll give them the price increase because they know in a few years they won't need them because of ChatGPT and AI. So it's like, okay, here you go.
Well, the other thing on that point is it's kind of similar to everything is go to those tweets and do a remind me of this in 3 or 5 months because the election matters in all of these things, geopolitical, domestic, everything. There's a reason that was settled so quick. There's a reason the geopolitical flare-ups, Ukraine invaded Russia after the big years of elections. There's reasons for that. And so that's where I think the risks sit in the 2025 horizons is these things don't get brushed under the rug so quickly in front of an election.
Yeah, well said. Well, let's wrap up here by just chatting a little bit about what we're seeing in terms of crypto markets. It looked like Bitcoin was about to break out past 65K, finally set that, that trend breakout higher, and then got reversed on geopolitical headlines. But, maybe Quinn, you can start us off by just seeing what you're seeing there. And I also want to compare to, some of the charts that Tyler was showing in terms of these small cap unprofitable stocks starting to moon and how it looks quite similar to altcoins. What are you seeing in the crypto space? Is it reflecting the same?
Again, people stare at like the 2-minute charts and like get crazy skewed in both directions. And market was super levered up, positioned super long. Everyone was screaming Uptober, and we corrected. And then people thought the world was ending. So it was a simple shakeout. All you had to do was look at the magnitude of the decline in stocks and small caps and NASDAQ and S&P and compare that to crypto. And, it was a very oversold move. And every day after those headline the headline dip, it bounced, and Bitcoin was extremely resilient at 60K. We rinsed a ton of overextended positioning, and we always say, we've said it before, you always get that flush. There's always a fake out before, and it's almost in every asset class. It's not just something to crypto, but for crypto, it's way more volatile because there's way more leverage positioning. And if your time frame is 3 minutes versus 3 months or 3 weeks, you're gonna get super nervy and probably puke those lows. But in reality, you do have this, like we said, geopolitical tension, but man, the macro is pristine. I think the strongest setup since the bottoms before these huge runs in like October 23 and December 22. And so yeah, I think you just gotta look beyond, and for the election too, right? I mean, does it really matter who wins? I still look at these traditional proxies like geo private prison stocks, coal stocks, Fannie and Freddie public equities. There's no premium priced in. Trump's not priced in the traditional markets, in my opinion. So I actually don't think he's probably priced in much in the crypto. If he doesn't win, yes, it's not as good, of course, right? Like one is very pro crypto, one is less. But we're talking status quo, meaning it's probably not getting a ton worse or tremendous upside. So I wouldn't be surprised at all if you got a pretty strong rip in these assets over the next couple of weeks into the election. Like everybody is hedged. Like everybody's already hedged. They're like, the fear is incredible.
If you look at the term structure, I should have brought a chart of the VIX. There's already a giant pop in late October and November, which is the beginning of this week, I saw, first of the month, the VIX term.
A lot of ads.
Yeah. So that's, October's already bid up. And then, November is kind of bid up, but yeah, it's all priced in already. And generally, I remember the previous election with Trump, the term structure was just like this. Everyone's already thinking, oh my God, it's going to be so volatile. And the event risk came and it got smashed down and everything ripped higher. Do you remember that? Like it was down like 4% in the morning.
Icon left the victory party in New York to go buy S&P futures. Yeah, he drilled a couple bill into S&P at midnight.
That's my view, is that no matter who wins, it doesn't matter. It's going to be a bullish, at least in the beginning, just because the amount of hedge unwinds that need to happen. Like it's going to be ridiculous.
That's so my read too.
I have a pretty interesting. It's a more actionable thing. Is I have it on, so take it for, it's not financial advice, but the other really interesting thing I noticed, and I was waiting for a while to put this on until the outlook lined up, is you have that kink in the VIX curve, right? Obviously for the election. There's also a kink in the Bitcoin vol curve, obvious reasons, right? Like makes a ton of sense. And it's not just a kink and back down, it's a elevation into, let's say, early next year on the term structure that kind of is spiked around the election. So that's in Bitcoin. That has existed in MicroStrategy stock. Makes sense, right? It's also existed. There's not options on IBIT yet, the Bitcoin spot ETF, but there's options on the 2X futures ETF. So BITX, it exists. Stupid. But where it hasn't existed, it's starting to exist, which is nice, but is all the crypto equities. There's a lot of Bitcoin miners and other crypto equities that I think there's a pretty nifty little upside volatility play there if people want to check out. But that's kind of my actionable play of the week.
I like that. You gonna do a little risk reversal? Maybe sell some pooters, buy some calls?
No, I just like being long the calls because I think Trump's underpriced and I think the macro's underpriced. So it's just my favorite expression, because
and they have huge short interests.
Yeah, and if stuff hits the fan, vol goes up, and my position is somewhat insulated from the delta going down, but the vol going up. So I love the stock replacement for crypto equities here.
I don't hold this at all, but Marathon has 80 million shares short. It's almost 30% of the float. If that squeezes, I mean, actually, it trades a lot of volume though, so it's only 2.5 days of short interest. But that one,
still, it's Tinder.
Yeah.
And the stars are aligning. And I bet you, Tyler, you could run those short interest numbers on the whole, garbage patch, as Paulo Macro calls it, which is like the 2021 SPAC stocks. You look at all those SPACs, I bet all those left for dead companies probably are still just, because it's just short those long QQQ. It's going to work. It's worked for 2 years. I wouldn't be surprised to see the same dynamic in those.
One of the most steady charts this year, it has been the Goldman Sachs most short rolling basket. It looks like the perfect inverse Head and Shoulders. Like just slowly rises every day. And it's all the stuff. And you just have like little popcorn stocks that pop up in this.
Recession, though.
iHeartRadio, Bed Bath and Beyond. It's like, that doesn't happen.
If only you knew how silly things are going to get, man.
Yeah.
Like when you're cutting 50 bips clips into 6-7% of GDP deficits and a resilient economy, stuff's going to get weird. Look, let's leave it there, guys. That was a great episode.
Banana zone.
Banana zone.
Yeah. Get your banana cakes. Look, guys, get a permissionless ticket. Come visit. Watch it live. It's going to be a ton of fun.
Wait, that's next week.
That's next week.
Our recording next week is live.
Next week is live. Yeah.
Quinn's going to do it shirtless for all the ladies.
I saw on the permissionless page that it said the dress code was casual. So yeah, maybe I'll wear one of Tyler. Maybe if Tyler can bring a couple extra beach shirts, we'll look like a 1970s rave up there or something.
Yeah, Don Johnson. That's before your time.
Yeah, I don't know who that is.
Google it.
There you go. All right, guys. Have a good weekend. See you live from Permissionless. Peace out.